What if the last crypto crash wasn't an accident? What if it wasn't just market sentiment or some random news headline? What if it was a planned attack pulled off in minutes by a few elite traders who hold more Bitcoin than most small countries? For years, people like you and me, the retail investors, have felt like we're playing a rigged game. Every time you think you finally got it figured out, the floor vanishes. Your stop losses get smashed and your portfolio bleeds red. You're left staring at the screen, wondering what the hell just happened, feeling completely powerless. Well, if you've ever felt like the game is rigged, you're not wrong, and it's costing you money. The crypto market, for all its talk of decentralization, is a playground for a small, secretive group of players we call whales. These aren't myths. They're people and institutions with enough cash to move the entire market with one click. They hide in the shadows behind anonymous wallet addresses, but their footprints are all over the blockchain, if you know where to look. In this video, we're not just going to tell you your suspicions are correct. We're going to do something much better. We're going to give you the enemy's playbook. We will break down their strategies piece by piece and show you the dark arts they use to manipulate prices, trigger mass liquidations, and walk away with profits from the chaos they create. This isn't a conspiracy theory. This is about connecting the dots with on-chain data and real-world patterns. Our goal is to arm you with the knowledge to see the attack coming, understand their moves, and protect your money before it's too late. So if you're tired of being their exit liquidity, stick around. We're about to show you how the magic trick is done. Before we get into the playbook, let's meet the players. So, who are these so-called Bitcoin whales? Simply put, a crypto whale is anyone holding a massive amount of crypto. For Bitcoin, the unofficial club membership starts at around 1,000 Bitcoin. At today's prices, that's a portfolio worth well over $100 million. Some whales hold tens or even hundreds of thousands of Bitcoin, giving them a level of market power that's hard to wrap your head around. Now, you might be picturing some lone wolf who got into Bitcoin back in 2010, and sure, those early adopters exist, some still sitting on forgotten fortunes in dormant wallets, but the modern whale pod is way more diverse. Today's whales are a mix of those early pioneers, powerful hedge funds, the crypto exchanges themselves, and even public companies holding Bitcoin on their balance sheets. Don't think of them as single people, but as a class of smart money, an elite group controlling the market's levers of power. Their real names are almost always a secret, hidden behind those long, jumbled wallet addresses. But here's the beautiful and terrifying thing about the blockchain. It's transparent. Every single transaction is a public record. So, while we might not know their names, we can watch their every move. We can see when they're buying, when they're selling, and when they're moving colossal sums onto exchanges, often right before a huge market move. This creates a wild dynamic. You have these anonymous, super powerful players whose every visible action is watched by millions of traders. Platforms like Whale Alert, which tweet out large transactions, have become must-see TV for anyone in crypto. When a wallet that's been silent for 10 years suddenly moves thousands of Bitcoin, the entire market holds its breath. We saw this play out several times in 2024 and 2025 as wallets from the so-called Satoshi era woke up, giving us a live experiment in just how much one old-timer can spook a now global market. One of the most fascinating recent examples is the entity known only as Mr. 100. This mystery whale has been adding exactly 100 BTC to their wallet almost every single day since the FTX collapse in late 2022. Many see this relentless buying as a massive vote of confidence in Bitcoin. While some analysis suggests the wallet is tied to the Upbit exchange's cold storage, the sheer consistency of the buys has made Mr. 100 a crypto legend, a perfect symbol of the quiet, immense power that whales wield. These players aren't just in the market, they are the market. Their size lets them influence prices not just by buying and selling, but through psychological warfare. They know that in a market fueled by fear and greed, perception is everything, and they use that knowledge to create the waves the rest of us just try to survive. So how does one person or a small group actually crash the market? It's a mix of brute force, clever stealth, and mind games. They hit the market on three levels: direct impact, controlling liquidity, and weaponizing fear. First, the direct impact. Crypto markets run on order books, lists of buy and sell orders on an exchange. When you sell one Bitcoin, it's a drop in the ocean. But what happens when a whale decides to market sell 10,000 BTC at once? That massive order steamrolls the buy side of the order book. It chews through all the highest buy orders, pushing the price down, down, down as it searches for anyone willing to buy. This is a flash crash, a brutal price drop that can happen in seconds. The whale's one move triggers a chain reaction of liquidations and panic selling, creating a downward spiral. We saw a textbook example in August 2025 when a single whale dumped over 24,000 Bitcoin, worth more than $300 $500 million at the time, sparking a flash crash that led to over $500 million in forced liquidations across the market. Second, they control liquidity. That's just a fancy term for how easily you can buy or sell something. When a whale pulls a lot of Bitcoin off an exchange into a private wallet, it reduces the available supply. This can be bullish, signaling they plan to hold for the long haul. We see this in on-chain data as large outflows from exchanges. But when a whale deposits a huge amount of Bitcoin onto an exchange, it's often a bad sign. It signals they're getting ready to sell. The market sees this and starts to get nervous, and prices can drop before the whale has even sold a single coin. During the downturn in September and October of 2025, analysts saw a huge spike in whale deposits, with over 17,000 BTC sent to exchanges by large wallets in a single day, right before a period of intense volatility. But here's where they get really clever. Dumping thousands of Bitcoin on the open market is messy and can drop the price too fast, even for them. So they often operate in the shadows through over-the-counter or OTC trades. Open trading company desks are private brokers for huge deals. If a hedge fund wants to buy $500 million of Bitcoin, they don't just mash the buy button on Coinbase. They go to an over-the-counter desk to find a whale willing to sell, and they agree on a price privately. This keeps the trade off the public order books and avoids an instant price shock. However, while the deal is private, the final settlement often still happens on the blockchain. On-chain analysts can sometimes spot these huge wallet-to-wallet transfers and flag them as likely over-the-counter deals. So while it avoids immediate chaos, it sends a powerful signal to those who are watching that the smart money is cashing out, possibly marking a market top. It's a high-stakes chess game where the most powerful moves happen just out of sight, setting the stage for the public crash to come. Now we get into the truly predatory stuff. If you've ever traded, you've probably used a stop loss. It's your basic safety net, an order to automatically sell if the price drops to a certain level to limit your losses. But what if that safety net is the exact thing the whales are hunting? This is a stop loss hunt, and it's one of the most brutal forms of market manipulation. Here's how it works. Whales can't see your individual stop loss, but they don't need to. They have sophisticated tools to see order book depth, and more importantly, they understand psychology. They know that retail traders are predictable. We tend to place our stop losses at obvious places, just below a recent support line, under a big round number like $100,000, or at a key moving average. These areas become giant pools of forced selling liquidity. To a whale, that's not a safety net. It's a target. The hunt begins. The whale starts pushing the price down toward that cluster of stops. They'll use a series of large sell orders to create intense, short-term selling pressure. The goal isn't to crash the whole market, just to nudge the price down enough to trigger that first big batch of stop-loss orders. Once the first domino falls, a cascade begins. Each triggered stop-loss is a market sell order, which adds more selling pressure, pushing the price down even faster. This in turn hits the next level of stops below it, and so on. The market sees this sharp sudden dip, that long nasty red wick on the chart, and pure panic sets in. Traders who didn't have stops see the crash and start selling to cut their losses. Fear takes over. And what's the whale doing during the chaos they created? They're buying. As thousands of traders are forced to sell their Bitcoin at lower and lower prices, the whale is on the other side of that trade, scooping it all up at a discount. They manufactured a dip just to fill their own bags. Once the cascade is over and the whale has bought what they want, they just stop selling. The artificial pressure vanishes. The price often snaps right back to where it was before the hunt, sometimes even higher. It leaves behind that signature long wick on the chart, the ghost of the massacre that just took place. If you've ever been stopped out of a trade only to watch the price immediately reverse and rocket up without you, you were probably the victim of a stop-loss hunt. You weren't wrong about the market's direction, you were just used as fuel. In the highly leveraged world of crypto derivatives, this tactic is even more devastating, wiping out traders completely. If stop-loss hunting is the whale's brute force attack, then spoofing and wash trading are their psychological warfare division. These tactics are all about creating illusions to trick you into making a move that only benefits them. Let's start with spoofing. This is when a whale places a huge buy or sell order, with zero intention of ever letting it fill. The goal is to create a fake sense of market demand or supply. Imagine you're watching the order book. You see a massive buy wall, an order for 1,000 BTC, sitting just below the current price. You might think, wow, huge support there. The price won't drop below that. Safe time to buy. So you place your buy order. But that 1,000 BTC wall is a ghost. The whale who placed it is just waiting for traders like you to take the bait. The second the price gets close to their giant order, they cancel it in a millisecond. The support everyone was counting on vanishes. The price suddenly has no floor and starts to fall, but it gets worse. The same whale who just canceled their fake buy wall is now placing real sell orders, profiting from the downward move they just engineered. They use the fake wall to lure in buyers and create someone to sell to. The reverse is also true. A massive fake sell wall can scare people into panic selling, at which point the whale cancels the fake order and buys up the cheap coins. It's a classic bait and switch. Then there's wash trading. If spoofing is faking intent, wash trading is faking activity. This is when a whale or group uses two accounts to trade an asset back and forth with themselves over and over. Why bother? Because in crypto, volume is king. High trading volume gets a coin noticed. It shows up on data aggregators like CoinMarketCap, attracts trading bots, and most importantly, it lures in retail investors who see the high volume and think, this coin is hot, I've got to get in on this. This is super common with new obscure altcoins. A group can take an unknown token, wash trade it to create millions in fake volume, and make it look like the most traded asset of the day. Unsuspecting investors get a bad case of FOMO and pile in, driving the price up. Once the pump is high enough, the wash traders stop their fake trading and dump all their real coins on the very people they just tricked. The volume disappears, the price crashes, and the FOMO buyers are left holding worthless bags. Back in 2019, a bombshell report from Bitwise claimed that a staggering 95% of Bitcoin's volume on unregulated exchanges was likely faked. Now, the market has matured a bit since then, but the practice is far from dead, especially in the wilder corners of crypto. Both of these tactics are illegal in traditional markets, but crypto is still the Wild West. Okay, we've just walked through some of the terrifying ways whales rig this market, from stop-loss hunts to spoofing. Feeling a little overwhelmed? Like you're just a small fish in an ocean full of sharks? That's understandable. But the point of this video is not to scare you away. It's to arm you. Knowledge is power, and understanding these tactics is the single most important step to defending yourself. It can feel like you're trying to decode an alien language when these whales have teams of analysts and billions of dollars. But every move they make leaves a trace on the blockchain. And there are tools that can help you spot these games as they happen. It's why we make these videos, to close the information gap. If you're finding this valuable and want to learn how to not just survive, but thrive, make sure you're subscribed with notifications on. We're just getting started. Next, we'll cover even more of the whale playbook and, most importantly, show you exactly how to protect your portfolio. Don't be their exit liquidity. Not all attacks happen on the order books. Some of the most powerful manipulation happens in your head. Whales know that crypto prices are driven by stories and emotions, so one of their favorite weapons is manufacturing fear, uncertainty, and doubt, or FUD, and its opposite, the fear of missing out. FOMO. First, they attack your confidence with FUD. Imagine a group of whales has built up a massive short position, betting the price will go down. It's now in their best interest to make sure it does. So they launch a FUD campaign. This could be leaking a negative, maybe misleading story to a friendly journalist. It could be firing up a network of social media bots to spread rumors that an exchange is about to collapse or a protocol got hacked. It could even be a well-known figure secretly backed by the whales going on TV and hinting at a coming crash. The information doesn't even have to be true, it just has to be believable enough to plant a seed of doubt. In a market this volatile, fear spreads like wildfire. Retail investors see the scary headlines, they see the panic on social media, and they start to sell. This selling puts pressure on the price, which creates more fear, which leads to more selling. The whale's prophecy fulfills itself. They created the fear, triggered the sell-off, and are now cashing in on their short positions, ready to buy everything back at the bottom from the people they just terrified. On the flip side of this coin is the FOMO engine. This is the classic pump and dump. Here, the whale's goal is to jack up the price of an asset they already own. They start by quietly buying up a huge supply of some low-cap, unknown altcoin without moving the price too much. Once they're set, they flip the switch. The FOMO engine roars to life. They might pay a group of crypto influencers to start shilling the coin, promising 100x gains. They might release a fake roadmap with exciting but empty promises of partnerships with major companies. They coordinate buying activity to create a sudden, sharp spike in price and volume. You see a coin suddenly up 200% in a day. You see your favorite YouTubers calling it the next big thing. You're terrified of missing out on a golden opportunity, so you pile in, buying at higher and higher prices, caught in a wave of pure greed. This is the pump. And what is the whale doing? They're selling. They are dumping their massive bag of coins, which they bought for pennies, into this retail driven frenzy. Once they've sold everything, they vanish. The hype machine shuts off, the volume dries up, and the price collapses, often falling 90% or more, leaving everyone who bought the hype holding worthless tokens. This cycle of manufactured FUD and FOMO is constant. It's a game where whales act as puppet masters, pulling the emotional strings of the market to drive prices wherever they want them to go. They know that if you can control the story, you can control the market. To see how these plays all fit together, let's do a post-mortem on a real event that sent shockwaves through the market. The flash crash of August 25th, 2025. It's a perfect case study of a whale attack in action. Here's the scene. On that day, the market was pretty calm, Bitcoin was stable, and most traders were leaning bullish. Then, out of nowhere, the floor fell out. On-chain data later showed that one entity started the chaos by dumping over 24,000 BTC, worth over $310 million. This wasn't a slow sale, it was a rapid, brutal dump designed for maximum impact. Phase 1 was the dump itself, a direct hit on the order book meant to cause panic, but that was just the opening shot. The real damage was from the chain reaction the whale knew would follow. This brings us to Phase 2, the stop-loss hunt. That first sharp drop was engineered to smash through key support levels where thousands of traders had their stop losses waiting. As the price broke those levels, it triggered a massive automated cascade of selling. This is what turned a dip into a flash crash. Across derivatives exchanges, this cascade caused over $550 million in forced liquidations of leveraged long positions. Traders betting on the price going up were wiped out in an instant. Phase 3 was the psychological fallout, FUD. As the price nosedived, panic took over. Headlines screamed about a crypto bloodbath. Sentiment flipped from optimistic to terrified in minutes. Retail traders, seeing nothing but red, rushed to sell, fearing this was the start of a new bear market. And all the while, the whale who started it was likely on the other side of these trades, selling at the top, triggering the liquidations, and then buying back their Bitcoin at a huge discount from the traders they just wrecked. They manufactured a crisis and profited from the chaos. What was interesting about this 2025 crash, though, was the recovery. The price bounced back faster than many expected, partly because of the growing presence of institutional Bitcoin ETFs. The arbitrage bots connected to these funds stepped in to buy the cheap Bitcoin, helping to stabilize the price. This showed a new market dynamic. Whales can still orchestrate these attacks, but the growing institutional plumbing is creating a counterweight. Still, the August 2025 crash is a chilling reminder of the whale playbook in action. It was a multi-stage attack combining brute force, a predatory hunt for liquidity, and a deep understanding of trader psychology. So now you know the playbook. You've seen the stop-loss hunts, the spoofing, the mind games. The big question is, so what? What can you actually do about it? Feeling powerless is exactly what they want. But you aren't powerless. By understanding their game, you can learn to sidestep their traps. You can't beat the whales, but you can learn to swim with them instead of getting eaten. Here are some real strategies. First, and most important, think like a whale, not like the herd. Whales prey on predictability. We know they hunt stops clustered at obvious levels, so make your stops less obvious. Don't place them at round numbers or right below a famous support line. Instead, maybe use a wider stop based on a volatility indicator like the average true range, which gives your trade more room to breathe during those violent wicks. Even better, set a price alert instead of a hard stop loss. If the price hits your level, you can look at the chart. Is it a fast, vicious wick that looks like a hunt, or a slow breakdown on high volume? Making a manual decision can save you from being a casualty. Second, become an on-chain detective. The blockchain is public. Use it. You don't need to be a data scientist to get good information. Tools like Whale Alert, Glassnode, or Arkham are out there. Start by watching the basics. Exchange flows. Are huge amounts of Bitcoin moving onto exchanges? Warning sign. Are they moving off exchanges into private wallets? That's a good sign. Following these signals can give you an edge, letting you see the storm clouds gathering. Third, scrutinize volume and order books. Learn to spot the fakes. If a tiny coin suddenly has massive volume but the price isn't really moving, that could be wash trading. Be skeptical. When you see a giant buy or sell wall appear, watch it. Does it disappear the second the price gets close? That's classic spoofing. Treating those huge orders with suspicion until they're proven real can keep you from getting baited. Fourth, diversify and manage your risk. This is simple advice, but it's critical. Don't go all in on one low liquidity altcoin. Those are the easiest targets for a pump and dump. Sticking to giants like Bitcoin and Ethereum makes you a much harder target. And most importantly, avoid excessive leverage. Leverage is what makes these liquidation cascades so profitable for whales. High leverage turns you into the perfect prey. By using smaller position sizes and limited leverage, you take away their favorite weapon against you. Ultimately, your best defense is to replace emotional, knee jerk reactions with calm, informed decisions. Don't panic sell into FUD, don't FOMO into a pump. Your greatest assets are your knowledge and your discipline. We've gone deep into the murky waters of the crypto market and laid out the secret playbook of Bitcoin whales. We've broken down their stop loss hunts, their illusions of spoofing and wash trading, and their psychological games of FUD and FOMO. The point of all this isn't to tell you the game is hopelessly rigged. The message is that knowledge is your shield. For too long, retail investors have been fighting blind, reacting with fear and greed, while whales execute a cold, calculated strategy. But now you know the plays. You know that a sudden, sharp wick isn't just volatility, it's a hunt. You know a giant sell wall might be a ghost. You know that a wave of social media hype could be a trap being set. Your goal isn't to outsmart the whales, it's to not become their lunch. By thinking differently about risk, using the blockchain's transparency, and staying disciplined, you can navigate these waters safely. Stay calm, zoom out, and never make a big financial decision based on panic or hype. You have the playbook now. Use it to stay one step ahead, protect your portfolio, and be a part of this revolution with your eyes wide open. Thank you for joining me on this deep dive. If this breakdown helped you understand the hidden forces in crypto, do me a favor and hit that subscribe button and turn on notifications. We're constantly analyzing the market to bring you insights that give you an edge, and I want to hear from you. Drop a comment below. Have you ever been the victim of a stop loss hunt? What other whale tactics have you seen? The more we share, the smarter we all get. Until next time, invest wisely and stay safe out there.